Good afternoon from the East Coast. Good morning from the West Coast. I'm Jeff Christian from CPM Group, a managing partner at CPM Group. I'm joined with Lon Shaver, who is the president of Silvercorp. We're here to talk about the real reasons to invest in silver now, the arguments or case that you can make that silver is an extremely attractive commodity and investment, even at prices over $30, as has been the case for the last several months. CPM Group produced a market commentary in October on the title, The Real Reasons to Invest in Silver Now. And Silvercorp sponsored that report to broaden the distribution of it and to get that message out. I will turn the microphone over to Lon for now to let him introduce Silvercorp a little bit more, and then we'll get into discussion about silver.
That's great. Thanks, Jeff. We at Silvercorp, a leading primary silver producer, we're very bullish on the prospects for silver going forward. We also think that investors should have the opportunity to hear about the research, opinions, and projections from people who make it their focus to follow these markets. And that's so that they can make better investment decisions. That's why today we're happy to collaborate with the CPM Group and bring you this webinar to discuss recent developments in the silver market and the work and the report that Jeff just mentioned. So thank you, Jeff. And I guess maybe we can kick it off here.
Sure.
Throughout different historical periods, like the 60s, 70s, and 80s, your report speaks to the fact that spikes in investment demand due to what were then and potentially now unique political and economic crises. Given the current global conditions, how would you say the present market and geopolitical arena compares to those past timeframes?
Yeah, it's interesting. I've been following silver for half a century professionally, but even before that, my parents and my other parts of my family were very much intense in terms of silver investments in the 50s and 60s. So I've been aware of it for a long time. But as you point out or allude to, the key is really like the investment is demand, the economic environment and the political environment. And what we have seen is really for the last quarter century, since around the year 2000, the political and economic environment has grown much more hostile to conventional, traditional investments and to overall economic activity. And it's done that in a way that is more persistent than has been in the past. Prior to, say, 2000, you would see 1 or 2 years of severe economic problems, recessions, inflation, and investors would pour into gold and silver. And then things would get better and investors would back away from buying gold and silver. Oh, okay, that was scary, but it's over now. And what we've seen since 2000, 2006 has been a persistently worse economic and political environment on a global basis. And that's caused investors to be much more continual in their demand for gold and silver. And, without, at the risk of sounding to take sides, I think that we're in an extremely hostile environment, probably worse than we were in 1979, 1980. In 1979, we saw the silver price go from $5 to $50. You had Soviet troops in Afghanistan, American hostages in Iran, oil prices quadrupled for a brief period of time. You had 14% inflation and 21% interest rates, and you were going into the deepest recession at the time in the post-war period. And after a couple of years, things got better. I'm not sure, well, over the last 25 years, we've seen things get a little bit better from time to time, but we've been really on full alert. And that full alert seems to be increasing this year. And our expectation at CPM Group is it's going to increase further over the next 2 years.
So do you sort of think, though, that in a way we've become kind of numb to some of these factors now that have typically been influencing moves in gold and silver?
I think you saw that for a while from, like, say, 2013 to 2016, 2018, where we had 0% interest rates, and you had inflation was relatively not a problem, but you had very slow economic recovery after the Great Recession and the global financial crisis. And you had downgrading of the U.S. Treasury in 2011. You had the sovereign debt crisis in Europe in 2010, 2011. And then we had this period of time of relatively anemic growth. And I think people started to become, as you said, inoculated against that kind of shock. But then I think COVID came along, the global lockdown, the post-COVID lockdown surge in inflation, but you also had a series of other issues. You had the Russian invasion of Ukraine, you had ongoing tensions in the Middle East, you had saber rattling against Taiwan and the Philippines and Vietnam by the Chinese government. So you've had this extended sort of rejuvenation of investor concerns. And as we saw with the US election, I made the joke because I really am apolitical in terms of US politics. People would ask me who I thought was going to win, and I said, I don't know who's going to win, but I know who's going to lose, the world. And it didn't seem to me that it's a matter of degrees, which side won, how much pain it would cause the world, because they were both, in my view, flawed candidates with flawed platforms. And I think that you've seen over the course of the last year or so a rejuvenation of investor concern, and that's been reflected in the stronger gold and silver prices since starting in April.
Now, that said, with the election behind us and seeing that we're pivoting to a new and apparently very different looking government going forward, it seems like some of the enthusiasm, or at least for the last couple of weeks, has faded with respect to gold and silver. What do you think when the handover takes place and we start to see some of the policies get enacted? What do you think will be the impact on gold and particularly silver in the coming year?
Our expectation is that the gold and silver prices, and to some extent it's been the election, but the prices actually peaked like October 30th, October 31st, as did the prices of a lot of industrial commodities, aluminum, copper, platinum, palladium, oil, natural gas, and they all fell starting at the end of October through for about 2 weeks until the middle of November. And part of that was clearly the election results, and you had a great deal of uncertainty as to what would be the election results, and that uncertainty faded away. We knew it would be Trump, and we knew there would be a unified Republican government. But those uncertainties have been replaced with a new set of uncertainties, like what's that US government going to do in terms of foreign policy, in terms of domestic policy, in terms of economic policy. And so after November 16th or so, you started seeing gold and silver prices rise again. You started seeing some pickup in investment demand in many parts of the world. Now, part of that was post-election, and part of it had to do with more elevated conflict in the Russian-Ukraine war, elevated conflict in the Middle East with Israel stepping up its bombing of Lebanon as well as Gaza. So you had a lot of other factors that were in there too. Our expectation is that from here well into the first quarter, well past Inauguration Day, you're going to see investors continue to be very nervous about what the new administration and new unified Republican government is going to do, and what kind of pushback it's going to get from Democrats and from the broader society and from global allies that may be upset with some of the things that the new administration may do. So I think that you're going to see a period of heightened uncertainty, and investors will be buying more gold and silver. So we're looking for gold and silver prices to strengthen between now and January and February. Beyond that, you might calm down once the inauguration's behind us, and you might see prices come off a little bit in the second quarter. There's also some seasonality into fabrication demand and investment demand for gold and silver that tends to be strong in the first quarter and weaken in the second quarter. And then beyond that, we think that you have this enormous menu of economic and political and financial problems that are going to keep investors interested in gold and silver as alternative assets, portfolio diversifiers, inflation hedges, currency hedges, political risk hedges, financial risk hedges. And we think that that's probably going to push investment demand sharply higher in the second half of next year and into 2026. And if investment demand rises along the ways that we're projecting, we think that you'll see further sharp price increases, and you may well see record highs in silver, if not on a daily basis, on an annual average basis.
And in your report, I mean, I guess going further, in your report, you're calling for these prices to rise and stay at higher levels for up to sort of a 3-year period. So you see those same factors, I guess, without picking specifics. You see a mix of those factors continuing to push those prices and keep them higher for that kind of time frame.
We do see it going into 2026. But, one of the things that we've said is we really have to see, we really can't predict what a Trump administration is going to do, what a unified Republican government's going to do. You can listen to some of the things they're saying and say those things could bring a recession to us sooner and deeper than otherwise would be the case. But then you can listen to other things they're saying and you can say, those things are going to probably extend the current period of economic expansion at least some amount of time. So there's a great deal of uncertainty as to what the Trump administration and the new unified Republican government are going to mean economically. In addition to which, you have all of these other agents or players that will be acting on their own best interests or on their own interests, and they will be to some extent reacting to whatever the US government's doing, but also acting independently of US government actions. And you've got this, as I said, you've got this menu of political uncertainties and economic uncertainties that are global, that probably are going to keep investors on the edge of their seats, we think, for at least a couple of years.
So amongst the mix of those kinds of factors, everyone's obviously been waiting and watching to see the speed and the depth at which interest rates get cut. How long are you expecting that to be a factor that could bolster commodity prices? And does that happen sort of regardless of what the strength of the US dollar is?
Well, I think the US dollar and inflation trends and economic trends will all factor into that. Our expectation is that interest rates will not go back to that zero interest rate policy that we had from, say, 2009 until 2019 or so. We think that you will see interest rates drop, but not get back to 25 basis points, maybe get down to 2.5 or so. Because you still have a lot of economic activity that is showing signs of weakness. We think that the Fed will, and other, the Fed, the ECB, the UK Bank of England, Bundesbank, they're all cutting interest rates because they're all seeing weakening industrial activity and consumption. But they're also keeping an eye on inflation because there are, while some of the cyclical inflation factors have gone away, there are some persistent secular inflationary pressures, mostly in the service sectors of the economies. And you have to pay attention. For example, you can look at some of the things that the Trump administration people are talking about, deporting workers. The United States is very heavily dependent on undocumented workers, not only in our agricultural, but in our construction and other industries. They're talking about tariffs, which show up in higher prices. They're talking about slashing government subsidies to various agricultural sectors and industries, all of which would suggest a lower economic activity, which would suggest lower prices, but also would have inflationary pressures that would suggest higher interest rates. So it's really going to be a mix. You know, our own view is that the dollar stays relatively strong, that inflation trades between, say, 2.5% and 4% over the next few years. So it doesn't get down to 2%, but there are these inflationary pressures that I mentioned earlier, mostly in the service sector. Inflation has come down in recent months, partly because you've had a sharp decline in petroleum product prices. And that has made the headline inflation fall further than the core inflation, which excludes food and energy. And that has sort of masked the fact that you do have these inflationary pressures continuing in various service sectors.
So let's switch back for a second and start talking about silver. And then I guess one thing that's maybe important to touch on is from a methodology standpoint, is in the way that you do the work and you study silver and you generate the reports, you exclude investment demand from your market balance calculations. I think it would be important for listeners to understand why you do that.
Right. Okay. Well, yeah, again, I've been doing this work since the late 70s. And in the commodities markets, across commodities, the standard methodology for looking at the fundamentals of a market is to look at total supply. So in the case of a metal, it's mine production plus secondary supply and any other sources of newly refined metal. You know, in the gold sector, that shows up as central bank sales when central banks are selling. Total supply less fabrication demand. And you exclude investment demand for a few reasons. One is it's very hard to measure across commodities. The second thing is that investment demand doesn't change the nature of the metal. When a fabricator buys metal and uses it to make something, whether it's jewelry or pens or electronic components or catalytic converters in the case of platinum group metals, that metal is transformed from being bullion that's readily saleable to metal in a product that often has a very low metal value to price. So you don't necessarily see that metal being as available for resale as you would with bullion or bullion coins. So you exclude it there. You also exclude it because while fabrication demand tends to be negatively correlated with prices, the higher the price, the less fabricators try to use. Investment demand tends to be positively correlated. Investors will chase the price higher, and then when the price starts falling, they'll dump it. So there are a variety of factors that you keep that out. And we follow that. You know, we call it Commodities 101. And you can look, in the case of gold and silver, starting in the 90s, some groups started adding dummy variables for investment demand to their supply-demand balance so that they could make the argument that their gold market and the silver market were tighter than otherwise you would think. And you can find, for example, bullion banks or banks that have commodities trading departments, and they'll have a report with 8 different commodities in there, or they might, or even more. And in each commodity, they use that Commodities 101, total supply less fabrication or consumption demand in the case of oil and agriculturals equals your market balance, except gold and silver. So including that investment demand excludes that. There's another reason why we do that, and it's probably the key reason. Investors want to invest in a market that is fundamentally tight. They want to invest in a market in which total supply from scrap and from mine production is very low or even less than fabrication demand. That's a very tight fundamental market. And some people will talk about that as being a primary surplus or a primary deficit, but it's a surplus or deficit. And investors like markets that run primary deficits. They don't necessarily, or they're less interested in markets that show a deficit because other investors are buying. They don't want to necessarily say, oh, that market would be in a surplus, but for the fact that investors are buying it, they want to buy a commodity that is in a deficit because fabricators need more than the industry is supplying them. So that's perhaps the main reason that we do that, because a lot of our work is for investors and they want to know, is this market really tight or is it just being pushed up by investors?
So I guess another way of sort of thinking about that is that if the investor demand is kind of setting the price on the margin based off of those immediate perspectives from investors, do you still see the fundamentals in terms of the fabrication and the industrial silver demand as having a real bearing on the silver price and the price direction?
Definitely. And I have to add, having gone through that whole description of supply versus fabrication demand, gold and silver are different from other commodities because they are, in addition to being industrial commodities that are used, they are financial instruments. And the financial portion of the gold and silver markets is much more dynamic. You have much more money that can be put to silver by investors than would be put to silver by fabricators. So it's a much bigger market looking at silver. And another way to put it is, it's far less than 1% of world financial assets are in silver. And, it's less than 1% in gold. But for gold, investment demand is and for silver, investment demand is a significant portion. So a very small incremental increase in the amount of investor funds going into silver is an enormous increase in the amount of investment money going into silver from the silver market's perspective. So that has a bigger effect. Now, fabrication demand is important because it provides that base for silver prices. There's a certain level at which fabricators can afford to use silver and will use silver. And silver has the advantage that among precious metals or noble metals, metals that don't corrode, metals that don't oxidize, metals that are more stable and are used in electronics and other critical applications, silver's the cheapest metal. It's competing with gold, silver, platinum, and palladium, which are far more expensive per unit to use. So wherever possible, a fabricator says, if I can use silver instead of palladium or platinum or gold, I will. So that's another factor that's in there. But the fabrication demand provides a stable base. And when the price comes down, you'll see fabrication demand rise. The silver price and the gold price were relatively weak from, say, the mid-1980s through the 1990s. And you saw this tremendous increase in jewelry demand during that period for both gold and silver, because jewelers said, these things are affordable and we can increase the per unit amount of gold and silver in our jewelry products, and we can increase the number of units that we're selling because these things are more affordable. So fabrication demand is very important because it provides that base price level where you have some support.
And so if investors are looking to get positioned in silver, sort of what are the considerations that you would say are important for timeframes to think about, and how would you recommend investors use different strategies for short-term versus long-term investment positions?
Yeah, okay, that's two sets of questions. The first thing is you need to, it's one of the more interesting things about my job is I'm not, I'm not a coal analyst looking at supply and demand for coal, fabrication, use of coal. I'm looking at supply, I'm looking at fabrication demand, and then I've got this investment component. And I say, well, what drives investment demand? And what drives investment demand heavily is a whole range of economic and political things. So I get to be spending a lot of time looking at international politics, domestic politics, economic factors. One of my detractors in the 80s said, Jeff Christian's not really good at predicting gold and silver prices. He's just good at predicting global economic trends and stock markets. I said, okay, I'll take that, but you have to pay attention to the stock market. You have to pay attention to the bond market, to the municipal bond market. You have to pay attention to so many different things, because those are the things that affect the investment market's relative attractiveness to silver at any given time. So right now we're looking at various proposed regulatory changes in the municipal bond market. One of the things that the Trump people have said is they are thinking of trying to tax municipal bonds. That would have a devastating effect on the municipal bond market and the finances of state and local governments. So that would be important. If they started doing that, you would have an enormous amount of money that's in this municipal bond market saying, I want to get out. Where am I going to put my money? Some of it will go into silver and gold. So you get to look at all these different esoteric factors, and some of them, they're not esoteric to the people involved, but they seem unrelated to silver, but they're not, because they drive that investment demand. And that's really important. So that's what you have to look for. Now, in terms of long and short term, we always recommend our clients have a long-term insurance policy that consists of physical gold and silver. And that if they are interested, they should also have a tranche of gold and silver that they trade based on intermediate term economic trends. Like, are we moving toward a recession? Well, maybe we are. And that's usually a sweet time for gold and silver, because investors are wealthy. We're not in the recession yet. The stock market tends to be peaking. So the stock market's about as high as it can be. Investors who are invested in stocks are getting nervous. Hey, the stocks are at record levels and we may be heading toward a recession. So maybe I should take some of my money out of the stocks and put it in somewhere. And that somewhere turns out to be gold and silver. So there's an investor, in our view, and this is how I handle my own. So I have that long-term insurance policy, which is a stack of gold and silver. I have an intermediate term trading thing that I trade on economic and fundamental trends. And then I have a short-term trading thing, which I trade more on where the price is and how fast it's risen or fallen. So today I'd be a buyer. Friday I might have been a seller.
Well, and then I guess there's one thing that we're sort of ignoring, the elephant in the room as it relates to alternate investments. Thoughts on how the cryptocurrencies are going to have an impact on potential shifts into the precious metals? Because that seems to be something we've seen here in the last few weeks.
There's a lot of talk about it, and my view, I look at, you look at the market volatility of gold and silver. What's the volatility of the price on a monthly average basis? And in gold, it's like 10 to 20%. In silver, it's probably like 15 to 25%. And then you look at the volatility of cryptos like Bitcoin, and the monthly volatility is 50 to 100%. So if you're an investor and you're saying, I'm looking for an asset I can add to my portfolio, which reduces the volatility of the value of my wealth, gold and silver makes sense. Cryptos don't. And then you start looking at other factors like the market cap, the value of outstanding amounts. and you look at the cryptos and you look at gold and silver, there's been a steady increase in the volume held by investors and the value held by investors. You looked at cryptos and the crypto market cap was less than $500 billion from the time they started appearing around 2014 until 2021. In 2021, they went from less than $500 billion to $3 trillion. In 2022, they went from $3 trillion to $800 billion. And now they're back up around $3 trillion. So you say, where do I find those kinds of returns? In gold and silver, you find returns that are similar to the US dollar and other major traded currencies. In cryptos, you find those kinds of returns in a slot machine. It's willy-nilly. I'm going to pull the lever. It could be 0% return, or it could be 100% return. So our view is that cryptos are the antithesis of gold and silver. They're not tangible assets. They actually are unlimited in volume, despite what people say. They're the antithesis of gold and silver as tangible assets. And I think that ultimately they will be very helpful to gold and silver. They have been over the last few years with this increased volatility, because investors say, this isn't gold and silver. This is a crapshoot. I'll go to Las Vegas if I want to play the slot machines, but if I want to protect the value of my portfolio, I'm going to be interested in gold and silver.
So can we make the comment, or can we suggest that from those extremes, where you suggested the strategy of being long physical for the long term, and then in the medium term, and then finding ways in the short term, could you say that equities of the producers or ETFs are somewhere in between that extreme of being straight physical and that crapshoot of cryptos?
It's a spectrum, and ETFs are very similar to physical metal, but they're not. And what we've seen in the gold market, less so in the silver market, for 3.5 years, from 2021 into the first half of this year, you saw investors selling their ETFs and buying physical metal. And what it was it wasn't that ETF investors were down on gold. They were worried about their counterparty risk. And they were saying, I don't own this gold and silver. I own shares in a Channel Island company that's run by a bank or a brokerage house. And so in 2021, 2022, you saw smaller ETFs disgorging metal as the investors were selling their ETFs and buying physical metal. And it was interesting because you saw an increase in investment demand for physical metal as the ETFs were declining. But no one reports, oh, I'm buying physical metal. It's CPM Group's data. But ETFs, you can see daily, weekly, and monthly changes in their holdings. So people take that ETF shift as a surrogate for investment demand, and they shouldn't, because in gold, I think ETFs represent about 8% of investor holdings, and in silver, they represent probably less than 20%. So they're not necessarily representative of physical investment demand, but people take it because the data's there, and it's the only data they have. But ETFs, what we've seen is that ETFs are closer to metals, but they, at the end of the day, have this counterparty risk that, given the state of the world right now, and given Credit Suisse going down last year and other banks having problems, and economic and financial issues, increasing the risks of holding assets in banks and brokerage houses, people are moving away from ETFs to physicals. Then you get into the mining shares, and mining shares have value because oftentimes when the silver price rises, the mining shares will rise even more. And that is good. And you're also investing in something that's real. This is the Berkshire Hathaway, Warren Buffett thing. It's like, I don't invest in gold and silver because they don't generate profits. I invest in gold and silver mining. Except when he went to visit, when Berkshire Hathaway decided that they wanted to invest in silver in the 1990s, they did a lot of research. And they said, the good news is that, yes, the silver price, which is languishing around $3.50 to $5.50, is likely to rise sharply, like multiple times at some point in the next several years. So silver looks like a good investment, but we're equity investors, and the market cap in the silver mining industry is so small, we can't get 2% of our assets into silver mining. At which point Warren Buffett said, well, then we should buy physical silver and hold it on an allocated basis away from the market. If I can't get 2% of Berkshire Hathaway's assets into silver, that's a market that is ripe for increase. And if the fundamental analysis suggests that the price could rise several fold, and you put that on top of a very small market relative to the amount of investable money, you have a very interesting investment. Yeah.
So as we get close to wrapping up here, I think you've touched on a topic that everyone's going to want to hear about, which is, what do you think are some of those potential price targets
Right.
for silver if things go the way that you think they will?
Yeah. Well, our expectation for the next quarter or two, into January, we have been telling our clients we thought that prices could drop as low as $29.50 and rise as high as $35.50. And we've been saying that for a couple months. And the price got down to $30 something today, and it's gotten over $35 earlier in the month and last month. So our expectation is that the price is probably close to its low on a short-term basis, and is likely to rise and could rise 5%, $5, which would be like something like 17% from where we are today over the next couple months. Longer term, we're looking at even higher prices. And people say, well, will silver get to $50 again? And we always point out, silver got to almost to $50 twice in history. One time that lasted about 10 minutes, and another time it lasted about 20 minutes. So you can talk on an intraday basis. Will silver get to $50? We think it will. We think like longer term investors, so we're looking at quarterly and annual average prices. And the annual average price, I think, peaked out around $34, $35 in 2011, 2012. We think that you will see higher annual and quarterly average prices, record annual and average prices over the next 2 years, because, as I said at the outset, your first question, we think that this is a much more hostile economic and political environment than we saw in 2011, 2012, 2007 to 2011. So we think that you're going to have a really rocky time politically and economically. And in that kind of environment, we expect silver prices to rise to record levels, both on an annual basis, and quite frankly, $50 could easily be pierced. I mean, if you're talking about an annual average price of $36 or $38 at some point over the next 2 years, the idea that the price spikes over 50 on an intraday basis is close to 100%.
Do you think, based on those kind of dynamics, that if the price is sort of more a slow and steady rise, it's more sustainable than if we do see those spikes that last hopefully more than 10 and 20 minutes through 50?
Well, yeah, it's interesting because one of the things that we have been seeing over the last several years is a more measured and slow and steady increase, which I think reflects the fact that you have more investors in more parts of the world interested in silver now than in the past. In the past, it was like, I have no interest in silver. And then all of a sudden it's like, oh, wait, the price is rising sharply. And a lot of people rush in, and then things are over and they go away. This time, I think, and we're already seeing indications over the last 20 years, really, we're seeing indications that more people are interested in buying gold and silver on a longer term basis at higher prices. And they're less put off by the fact that prices are already high. I mean, I'm sure you hear it all the time. I hear it all the time. People say, why are silver prices so low? I would say silver prices are not low from a historical standard. They may be low from where they're going to be in 2 years, but they're not low by a historical standard. They're very high, and they rose in advance of some of the concerns. The concerns are catching up, and I think that silver prices, which have made a big leg up from 2019 to 2024, probably have another leg up, perhaps of equal size.
Well, I guess the market's full of different opinions and different views of the data, and that's what makes the market, right? So.
Right. You used the phrase before, can we say? And I was going to point out that that's one of the great things about gold and silver is, unlike stocks and bonds and currency markets, they are unregulated. Anyone can say anything. And they do.
Yes, we certainly see that in this space.
Mm-hmm.
Well, thanks, Jeff. I think good to stop here. And maybe what I would suggest is, just given some of the topics that we've touched on, there could be some reason to rejoin and to put another call like this together here, maybe early in the new year. Generally, the new year seems to be a good time for precious metals, and got some extra intrigue layered on top of that this year. So maybe we can suggest that we reconvene for a follow-up chat early in the new year.
Well, yeah. After next year will mark the 50th year in which I've written something about commodities. The first thing I ever wrote about commodities was in 1975. So I'm going to stick around for at least another year just so I can make my 50-year anniversary.
Well, and hopefully you have something big planned for that.
I don't.
Well, you've got some time to work on that. So.
Okay, it's a good idea. Thank you.
That's great. Well, thanks, Jeff.
Well, thank you, and yeah, we'll be here.
Always a pleasure to hear these insights, and certainly some very exciting themes that we, as a silver producer and obviously keen on the silver market, are excited to hear and to watch going forward. I'd like to thank everyone for joining us today for the call, and may everyone have a happy end of the year and good markets. And like I said, hopefully we can reconvene and do this again early in the new year.